It is Friday the 16th of August. I'm your host Ryan Kia, and this is the Quantium Cast. Okay, so before we get on to today's focus stocks, I just wanted to share this interesting statistic with all of you. It talks about sales in department stores rising for the first time this year in July, and the ONS, aka the Office for National Statistics, had just mentioned that this was an unexpected rise. In fact, monthly retail sales rose 0.2%, defying forecasts for a 0.2% fall. But they've mentioned that this was boosted by online sales, so the high street could still be dying, the retail sector could be finding things difficult, but online sales obviously are still growing as the consumer switches to an approach that is more convenient for them. However, it's quite weird when we talk about convenience with online shopping, because you can't exactly try the clothes on. Imagine ordering something and say it didn't fit you. What do you do after that? Well, you return it, don't you? And I looked at some figures. Apparently in the UK, the return rate on something like full price purchases is about 40%. The online sales market needs to account for this, whether they use technology, for example, artificial intelligence, to find out what people's sizes are, and also give them a rough idea of what they're actually purchasing, instead of tricking them by showing the quality of the product to be much better than what it actually is. Say you want to return it afterwards, the company has to sometimes pay packaging, and this is quite a large expense. Nevertheless, let's get into today's focus stock. So we have a half-year earnings report from Quarto Group. We have an acquisition of ISS assets, Innovation Science Solutions, by Cello Health, and we will finally look at the full year results for SolGold PLC. It seems that today is very dry on the news front, but don't worry about it. We've got a lot of notice of results. RNS is out today, so next week should be packed with updates. Okay, so beginning with the Quarto Group. This company is a self-proclaimed leading global illustrated book provider, and they have just announced their unaudited half-year results for the 6 months ended the 30th of June 2019. Revenue seems to be about stable, net debt seems to be down approximately 10%, but the company still reported a loss after tax of $3.6 million, down from $6.7 million in the previous period. One must note that these companies are struggling because not only is there a push on margins as a result of the technological era, you've seen publishers have to reduce their pricing and also increase their costs to maintain their supply chains. Something to also note is that the company isn't just making a net loss after tax and a net loss before tax, but they are also making an operating loss, meaning the business is not actually making any money. They've showed that their adjusted operating loss was down 75% at $1.2 million. So yes, there has been some improvement in an operational sense. The company has been losing less, but they are still losing a lot of money. The company shares have fallen off a cliff and have stayed about the 67 pence per share level. They had highs in the past 52 weeks of about 100 pence, and in the past 5 years they peaked at around £3.17 in January 2017 and have fallen gradually with a couple of dead cat bounces on the way down, and have made lows around 50 odd pence per share. So I assume this won't be taken that well by shareholders, but it's unlikely that they will have predicted this company to make a profit, because they'd lost so much in 2017. They'd lost not that much in 2018. In 2017 they lost about $18 million, but in 2018 they'd lost just under $1 million. The company has a lot of illiquidity issues, in a sense of, if you were to try and trade this stock, I assume selling would be at a wide spread of at least a couple of percent. And if you have a large amount of size in this share, then exiting your position will likely result in the shares dropping and you probably get spiked there. We've also got to note that a company is a very small business. They have a market cap of £14 million, and the volume of shares traded per day isn't that high. In fact, many days you'll have 0 shares traded, and that has been quite a popular thing over the past couple of months with this share. If you have a couple of spikes in volume, they may just be one individual or entity, or maybe a couple of individuals and entities getting involved in the shares, going along or disposing of any positions. Moving on to Cello Health. This company is a healthcare-led advisory group, and they have just mentioned the acquisition they have made of the trade and assets of Innovation Science Solutions LLP. The total consideration will be about $10.5 million, and $6.4 million of that is payable in cash, and that's an initial consideration, so I believe it will be paid immediately. Either the company will dig into their cash position, or they will use existing debt facilities, say with banks. And they've also mentioned that $4.1 million of that will be payable in 4 tranches, which is a deferred consideration. That's dependent on their financial performance from the 1st of August to the 31st of July 2024. So there's about 5 years worth of payments for Cello. What I like to see in this RNS is that ISS is actually profit making. They've mentioned they have an unadjusted profit before tax of $2.8 million and an adjusted operating profit of $1.8 million. So, and the company also has assets of approximately $1.7 million. So Cello are actually paying to acquire some assets whilst they're at it. They are profit making. So it seems that this acquisition by the company may actually improve their overall performance, the overall performance of Cello Health. However, in comparison to the company's market cap, this acquisition doesn't represent a large boost to them because their market cap is at £136 million. This acquisition is about £8 million worth of cost to them. I assume that they're probably taking on some additional debt for this, because a lot of companies of this size, especially in the health sector and research, these companies usually don't have that much cash at one time because they're usually burning through it through R&D, aka research and development. So the company's shares have made 52-week highs of 139.5 pence per share, and their 52-week low is 95 pence per share. So they don't really have a lot of volatility. I mean, on May the 27th, they were 137 pence a share. On June the 27th, they were 111 pence a share. And by July the 18th, they were 126 pence a share. And they've gradually risen a couple of pence to the current price of 128 pence per share. And finally, SolGold PLC report their full year results for the year ended 30th of June 2019. This company's shares have performed extremely well over the past 5 years. In fact, on the 18th of December 2015, the company's shares were trading at 1.25 pence per share, and they rallied all the way to 42, in fact highs of 46 odd pence per share on the 26th of May 2017. Not bad for a return that you'd only have to wait 2 years for to get 20-30 times your initial investment. Really impressive. The current price of the shares stands at 27.3 pence per share, with year lows of approximately 20.5 pence per share and year highs of 42 odd pence. I assume that the main reason as to why the company shares had rallied had been a result of the Alpala discovery, and they've shown that they can also update their mineral resource estimate to quite a strong level, in fact. And BHP Billiton, a massive international conglomerate had also noticed, and in fact they subscribed for 100 million shares at 45 pence per share, which is really impressive. And the company has also said that they're trying to acquire, and when I mean the company I mean SolGold, they're trying to acquire the entire share capital of Cornerstone Capital Resources, and it's supposed to be formalized and completed shortly. They have a nice cash balance of $41.7 million in comparison to $60 million in 2018. So actually that has depreciated by quite a bit, but they're not in an immediate cash call position. They can still survive without having to raise money and pay their directors' fees and also pay the required maintenance for this project and also get it into production. SolGold has a market cap of approximately £500 million. That is quite high for a company that isn't revenue producing, but once again their assets do have quite a high value. And one impressive thing to look at is that they don't really pay out that much remuneration to their directors, but the issue we have is in the share options. That's doubled, in fact not doubled, but near doubled, from $4.5 odd million, and these are US dollars, in 2018 to $7 million in 2019. And the performance of the shares in a year, yes, they're up a little bit, about 20-30%, but from their highs in the year, they're down about that much too. Here's where it gets ugly though. The company reported a loss for the year of $32 million. And in 2018, they lost about $15 million. I can see the majority of their losses come as a result of share-based payment expenses. Either these could be to pay for the acquisition, I assume, which is fair enough, but it depends what proportion of this accounts for that. If these are share-based payment expenses for management or, say, companies providing consultations and advice for, say, the company's development, or more specifically the development of their project, with that kind of loss, you'd expect the company to run out of cash within, say, a year and a half odd. It is good to note, however, that the company doesn't have many liabilities. They've got $6.5 million in liabilities and approximately $240 million in assets. I can only assume from this that the company is trading at a slight premium, in fact, a 2 times premium to their total asset value. And if we take the liabilities off, they're about there too. This company is probably trading based off a little bit of momentum and also the subscription for extra shares from BHB Billiton and in other institutional investors. In fact, the fact that they see value in it, I assume that the asset may yield a lot more potential in the long run. However, what is important for us is that this share has a nice trading range and we'll be able to show it in our chart pack later. So that wraps up today's episode of the Quantium Cast. But if you want insight into the technical side, keep your eyes peeled for any additional content posted later on in the day, including analysis of charts of companies discussed in this podcast. But first, head on over to our site, quantiumresearch.co.uk, and download the relevant chart pack for this episode. I've been your host, Ryan Kia. Until next time.